couple of comments from administration officials I wanted to get your reaction to. The Treasury Secretary and others have suggested that Dodd-Frank regulation and the way it's been applied have restricted credit growth in the economy. Banks are not making loans that they otherwise would, and that has slowed growth. Do you agree with that? And if you get a new vice chair of supervision who wanted to ease up on regulation, would you go along with that? Also, I wanted to ask you, it's been reported the president has congratulated you on being a low-interest person. Would you agree with that characterization of your philosophy?
Well, with respect to the impact of credit conditions and bank regulation on slow growth, I've previously in testifying indicated that I don't think that our regulations have played an important role, at least broadly speaking, in impeding credit growth and the growth of the economy. And I pointed in the past to a number of statistics suggesting that credit growth continues to be healthy, including among smaller community banks that are most concerned with regulatory burden. I think when banks are undercapitalized and weak, that impedes credit growth. And when banks are strong, they're in a much better position to lend. So that's been a view that I've stated previously. Now, in terms of regulation, the Treasury recently issued on Monday a detailed report. And that's quite a complicated document with lots of recommendations in it. I haven't had a chance to review it thoroughly, so I don't want to comment on too many details, but I would say it underscores the importance of capital, liquidity, stress testing, and resolution planning in having a safe and sound banking system, which are views that I and my colleagues have long espoused. Regulatory burden, when it's possible to ease it, and a good deal of the Treasury report is focused on regulatory burden. That's something that all regulators should be looking to do. We strongly believe in the importance of tailoring our regulation to the size and complexity of institutions, of finding ways to relieve burden for community banks. We have been focused and had a number of initiatives already in that direction, looking for ways, for example, to simplify capital requirements for community banks, and will continue in that direction. And in that sense, in those areas, certainly share the views expressed in the Treasury report. So there are a number of areas and suggestions where our thinking aligns well. There are probably some areas where we're likely to have differences, but quite a number of areas where we're likely to be able to, and already are taking actions that are consistent with those recommendations.
And the characterization of you as a low interest rate person?
Well, I have felt that it's been appropriate for interest rates to remain low for a very long time. We are in the process of, as the economy strengthens, normalizing interest rates, but certainly we've had a lot of years in which interest rates have been low. I thought it was necessary to support the economy at that time and was strongly in favor of those policies.